Okay, we are going to start. Today, what we will do before starting the lecture is just let's look at what we did up to now. Because today we are going to discuss about the monetary transmission mechanism. That is about how when the central bank take any monetary policy action, how will that be transmitted to the real sector? Because we know the final objective of conducting the monetary policy is to maintain price stability. And also price stability is directly associated with the movement of goods, this aggregate demand and supply, because aggregate demand and aggregate supply are in the real sector. So when the central bank takes some action, how will that be transmitted? There are different channels. Those are we are going to discuss today. But before going to that, let's look at this. How far we have gone. I am going a little fast, and also you must have received this expanded lecture, because as I said at the very beginning, this topic is a little bit longer and also a little bit more technical topic. Therefore, we could not complete that within 1 hour, this one lecture. That's why we did like that. Let's look at what we did up to now and also ask if you have any questions from there. We went for the definitions and objective, scope, instruments, and today we are going to discuss the transmission mechanism and also limitations. Those are the two topics that we have discussed today. And definition is clear. There are so many different ways of defining the same thing, but as we discussed last time, final objective is the same, and it has short-term objectives, medium-term objectives, and also the long-term objectives or the final objective. Final objective is to achieving prosperity or the sustainable growth. For that, there's a long way to go. Then by looking at this, you can understand. But feel free to stop me at any time and disturb me and ask questions if you have. Then we went to this. What are the intermediate objectives and also immediate objectives? Then we went to the scope. There we said there are two sides to the economy: aggregate demand side and aggregate supply side. Aggregate supply side, central bank has no control over the supply side. Therefore, only way that the central bank can influence the prices is by influencing the aggregate demand. That's what we said with this graph. And also, we looked at different approaches of monetary policy, that is monetary targeting and inflation targeting. They are the related concepts also we discussed. Then we said most important variable that the central bank focuses on is the interest rate, market interest rates, and central bank can influence that by either change in money supply or directly changing the policy interest rates. That's what we discussed under this, and also this indicates how changes in the money supply affect the interest rates in the market. There also we discuss there is no control that the central bank has over the demand for money function, because demand for money is a behavioral variable. How much money people are willing to keep in different forms depends on their preferences. We discussed about different monetary aggregates, and also we did not go to the details, but you are familiar with those things from your earlier lectures at the IABF and also from IABF economics and also survey of financial survey of financial institutions. Then we said, okay, the interest rates and the interest rate and the money supply are negatively related. Higher the money supply for a given demand for money function, lower the interest rate, lower the money supply, higher the interest rate. That's how the central bank changes interest rate by changing the money supply. This is monetary targeting. You target the monetary base, thereby you target the money supply level. Then finally, you try to achieve the changes in the interest rate. Inflation targeting, we discussed about associated with two different gaps, the inflation gap and also the output gap. The important thing was there was target inflation rate for the central bank and projected inflation rate and potential output level and the actual output level. And also we said sometimes central bank can look at not the current output level but future. Here also we just change that by putting not t but t plus 1. Those things we discussed. Then we went to explaining the gaps. Here we said we have a positive gap, negative gap, and when the economy has a positive output gap, it also has a positive inflation gap. And when the economy has a negative output gap, it has a negative inflation gap. Then we went to identifying the gaps in a different way. There what we did was we took the long-term growth path of the economy and also the inflation target of the central bank for a given period, that is also long-term. But we said practically, actually, even though it has a long-term growth path, when you take a long-term time horizon, in a shorter period, you can see the economy moving in a cycle like this. This is still said, okay, this is the business cycle. Sometimes output can be higher than the potential for a shorter period. It also can be lower than that. Depending on that, if the output gap is positive, we said, and inflation is also, gap is also positive, you can see, because actual inflation rate is higher than the target inflation rate, then this is a sign of economy being overheated. Then you have to cool it down. Then the nature of the monetary policy should be contractionary. But here it is the other way around. Economy is slowing down, gap is negative, output is lower than the potential, inflation rate is also lower than the target. In that case, if the economy is, this is a kind of a stagnant environment, then you have to stimulate the economy. Here, you have to cool down the economy. Cool down because it's overheated. Here, you have to stimulate. It is stagnant. This is another way of understanding those concepts. Then we went to monetary policy instruments. Instruments are basically, we said, quantitative and qualitative. Quantitative one are measurable and also they can influence either monetary base or the money multiplier, because here we have to understand the money supply is the combination of monetary base and money multiplier. And when the central bank target when the central bank follows monetary targeting, they try to influence the base or the multiplier, thereby change the interest rate so that the market interest rates will change accordingly. Here, and when you take the monetary base, open market operations, central bank, it is here. Central bank either sell or purchase, buy or sell securities that the central bank is holding. Mostly these securities, as we said, are government borrowing instruments, treasury bills and bonds. Here we have to mention one more thing. Sometimes, now we know the central bank will be able to hold treasury bills or bonds. Basically, central bank holds treasury bills, but only if the government runs a budget deficit, because treasury bill and treasury bond are borrowing instruments. The government does not have to borrow, there won't be any borrowing instruments for the central bank to use for the monetary policy purposes. In that case, the question arises, should there be a budget deficit requiring the government to borrow by issuing the treasury bills and bonds for the central bank to conduct monetary policy by conducting open market operations? The answer is no, because sometimes if a highly disciplined government, now there are some governments in the world, Singaporean governments like that, they have a budget surplus. If you have a budget surplus, there are no borrowing instruments. There is no need to borrow. There is no borrowing instruments. In such cases, central bank can use its own authority to issue central bank securities. Central bank itself. Now, in case of Sri Lanka, treasury bills and bonds are also issued by the central bank, but not on central bank behalf. It is on behalf of the government. Central bank, under the agency function of conducting, supporting public finance, managing public debt, central bank issues. But they are the liabilities with the government. Issuer is a central bank. But in case the government has no budget deficit, without any requirement to borrow, in such cases, just to create an instrument for the central bank to conduct monetary policy, central bank can issue its own securities, central bank securities. Then the issuer is the central bank. Liabilities also with the central bank. Central bank can issue. So there are two ways of doing this. I mean, two type of instruments to conduct open market operations. Government borrowing instruments and also central bank securities. Here the policy interest rates. Policy interest rate we discussed. The policy interest rates can be adjusted by the central bank and influence the financial inflow and outflow between commercial banks and the central bank. We know standing deposit facilities. Deposit facility is allowing the commercial bank with surplus funds to deposit with the central bank. Standing lending facilities allowing commercial banks to borrow from the central bank. When the commercial bank deposit money, what happens? Money comes in. So monetary base goes down. When the central bank lends, then the money goes out, monetary base increases. So whether the commercial banks, now, depending on whether the central bank changes those policy interest rate, that is standing deposit facility rate or lending facility rate, there will be encouragement or discouragement for commercial banks to deposit money and borrow money. Now, if you look at the recent times, we have seen that the continuous central bank has been cutting the policy interest rates down just to encourage banks to lend. Those things we will discuss because there's another slide coming for that. Then the other one is we said, okay, statutory reserve ratio. This is under prudential purposes, central bank imposes requirement on commercial banks to deposit some money with the central bank. So depending on whether this rate is higher or lower, credit creation capacity of the banking system changes. Accordingly, money multiplier also changes. So central bank also can adjust this. There will be a slide I have put where all these rates have changed over time. Those things we will discuss. The other one is moral suasion, just maintaining a continuous and cordial relationship with the banking community. They can influence not through instruments, but just through understanding for commercial banks to work in line with the central bank's objectives. This is simply the impact of adjustment in the policy interest rate on the market interest rates. We said central bank can think, and also here we have seen it over time. Now this is at a particular point of time. The gap with the deposit rate, lending rate, we drive. Oh, this is simply, as we said, this is simply showing how the market interest rates will move within the corridor once the central bank set a corridor like this, because no bank will borrow elsewhere at a higher rate than the central bank charges for commercial banks to borrow, and also no bank will go outside and deposit money at a lower rate than that. So the market rates can only fluctuate within this range. So then when the central bank raises this up, market interest rates also will go up. When the central bank lowers them, market interest rates also will go down. Now here we have shown that how over time, within 2020 only, how the central bank has lowered the interest rate continuously. starting from March. Actually, in March, 2 times. In April, May, June, July, they have gone down. And also SRR also has been gone down. And bank rate also has gone down. And we will discuss the reasons for those things. Then when we do this, how the impact of those policies influence the real sector is monetary transmission is about that. Transmission. You transmit the influence of the monetary policy, monetary variables onto the real sector. This is about that. Did we discuss last time? Anyone who can remember? Yes, not visible. The camera has been right. Okay. Now you can see me. Did we discuss this monetary transmission mechanism in detail, or did we just introduce it? Anyone who can help me? Hello, Sachintra or Patum? No one talks. No. Right. Didn't discuss. Okay, right. Didn't discuss. Right. Then we will discuss today. Okay, let's start with monetary transmission. Let's just start with the definition. Monetary transmission mechanism is the process. It's a process. We have to understand that. It is a process. It's a process by which the asset prices and general economic conditions are affected as a result of monetary policy decisions. Now here, they focus asset prices and the general economic conditions. That is one definition for that. Such decisions are intended to influence aggregate demand, interest rates, and amount of money and the credit in order to affect the overall economic performance. Okay, then you can see final objective is economic performance. And also in between, we know when the economic performance changes, the prices also automatically changes through the markets. Let's look at the other one. This is the process. Again, here it says a process. This is the process through which monetary policy decisions affect the economy in general and the price level in particular. The overall economy in general, but the particular price level is in particular, because now the objective of central bank conducting the monetary policy is to maintain price stability. Therefore, particularly, central bank is concerned about to what extent the monetary policy can affect the overall price level. And further explanation is there. Transmission mechanism is characterized by long variable and uncertain time lags. This is very important. Long variable. It is a long variable and uncertain. There are three things. It takes a longer period. And also, there is no particular rate at which it will affect. There will be different ways of this transmission going through, and also uncertain time lags. In case of Sri Lanka, they have identified the transmission lag in Sri Lanka for the monetary policies 18 to 24 months. There are some countries where also it is more than 1 year. Then you may ask, now this transmission lag is 18 to 24 months means if you take a monetary policy decision today, just today, if you take a monetary policy decision today, for the economy to feel it to the full extent, it will take 18 to 24 months. Then you can see central bank cannot influence the economy today by taking decisions today. It is always forward guidance. Last time also we discussed, because if the policy is going to impact after 18 to 24 months in the future, central bank has to look at that. That's what we said. Central bank has to forecast, project, and giving a guidance to the economic agents. Okay, this is our objective. We want to maintain this That's why we are taking these decisions. Then it gives a signal to the economic agents. Better you also align your expectations, your plans, and execution of those plans in line with the central bank objectives. This long lengthiness is very, very important. And the other one is variable. It varies. Now, suppose, for example, if you adjust the policy interest rate by 50 basis points last month, and it affected the economy, let's say the price level went down by 2%, let's say. Next time you can say, okay, when the central bank adjusts the policy interest rates by 50 basis points, again, the price level will change by 2%. You can't say that because sometimes it can be 2%, 1%, there's no change at all, higher percentage. That's why it says a variable. And the uncertain time lags means in certain periods, the economy can feel the monetary policy influences in a shorter period. Some other times it can take in a longer period. It varies. Time lags are uncertain. Sometimes it may not affect at all. Therefore, I emphasize being very clear about this lengthiness, variability, and uncertainty in time lags. Thus, it is difficult to predict the precise effect. This is important. Therefore, it is, let's underline it. Because of this situation, final outcome is this. Final outcome is thus, or therefore, it is difficult to predict the precise effect of monetary policy actions on the economy and the price level. Okay. Let's articulate a question from this. If somebody can raise a question, why is it difficult to predict? Why is it difficult to predict the impact of monetary policy on the economy precisely? Or why can't somebody assess precisely how the monetary policy affects the economy? Then what we have to do is to explain the nature of the monetary policy is such that it takes a longer period for the economy to feel it, and also there is no particular given pattern for the economy to feel it, and also the time period also can vary. Therefore, it is difficult to predict. That is the answer. If there's don't misunderstand, because this is not a question in the coming exam. I'm just saying somebody can, because I'm trying to say this is a crucial point. This is a crucial point because of those attributes, that is the lengthiness, variability, and uncertainty. This could happen. Therefore, sometimes you may have seen central bank did this, central bank did that, but nothing happened. Like sometimes people tend to criticize the central bank monetary policy, not only in Sri Lanka, some other countries as well. The thing is this: it is an uncertain thing. It's you are doing something without exactly knowing what could happen, because in between there may be so many situations, so many variables affecting your policy decisions, and also there are so many changes in the environment where you have no control. You have no control over. It's like, okay, you promise a friend, okay, within 30 minutes I'll be there, but sometimes it may take 1.5 hours for you to go there, because at that time, if you had a precise monitor to check the road conditions and traffic conditions, and then give the time, you can have it. But once you drive onto the road, only you understand whether the traffic congestion is high or not. Therefore, we can't predict. But if you're on highway, you can say, okay, I am at this entrance, and within this many minutes, I'll be at this entrance line, because there are no constraints in between. You can just precisely tell the time. If your speedometer is working properly, you can say, okay, it will take this many times for me to reach there. It's like that. Okay, then the other one, monetary policy transmission mechanisms are channels. This is another one. There are many channels through which this monetary transmission goes. There are many channels through which changes in monetary policy rate, changes in the policy rate affect the behavior of economic variables, mainly prices and output. Thus, the demand for domestic goods falls. Thus, the demand for domestic goods falls, reducing the pressure. Oh, I'm sorry. This is something wrong. Okay, please. By mistake, I have put this. Thus, the demand for domestic. No, it should have been another slide. That's why by mistake it has come here. Please cut it. Okay. So monetary policy transmission are channel. The monetary policy transmission mechanisms are channels through which changes. Okay. Now we understand that. So it is a mechanism where the decisions of the monetary policy affect the real sector. There are many variables, output, prices, asset prices. There are so many things. So mechanism is that, and immediately does not affect. So it takes time. It's lengthy, and also there is no particular pattern assets. It is variable. It can change, and also it can take different time for the economy to feel the impact. And then we go how this is transmitted. So the earlier one was the nature. Lengthy is the nature. Variability is the nature. Uncertainty is the nature. Next one is channels. What are the channels through which this impact of monetary policy is transmitted? Let's look at that. Okay, here official interest rate, and here you can, if you want, you can put before going to that, because this is central bank is changing the official rate. It's like inflation targeting, because under inflation targeting we said monetary targeting is influencing the interest rate by changing the money supply, thereby changing the monetary base. Then the market interest rates are affected. Then if we are talking about the monetary targeting framework, you can say changes in money supply. You can replace this with changes in money supply. When the money supply changes for a given demand for money function, market interest rates will change. So there is no difference. Here directly central bank is influencing the market interest rates by changing the policy interest rates. This is the mechanism that starts with under inflation targeting framework. Under monetary targeting framework, let me repeat again. If it is under monetary targeting framework, central bank will change the money supply. There also, if you want, you can put here central bank change the monetary base. Changes in monetary base will change the monetary base or money multiplier. Monetary base or money multiplier. Then that will change the market interest rate. Again, all other things will change accordingly. Let's look at. You can see there are so many channels. Okay. Assume that central bank is conducting the monetary policy with inflation under inflation targeting framework. Then central bank decide the official interest rates. That is, in case of Sri Lanka, central bank can adjust the interest rate corridor. Standing deposit rate and standing lending rate. No, standing deposit facility rate and standing lending facility rate. After that, market interest rates will change. Then what happens? And here there are two things. When the policy rates are changed, there are two effects. It directly affects the market interest rates. And also, it affects expectations. It is called expectation channel. Okay, take for example, market interest rates we can understand. When the central bank set the rates, it also will affect the bank's operation with the central bank. And also it gives a signal. Central bank is going for a, let's take the recent scenarios. Recent times, central bank has been conducting throughout in the short period, central bank has been conducting expansionary or easing monetary policy by cutting the interest rates. So the market interest rates also will go down. Last time we discussed, those days the bank rates were, deposit rates were around 10 or close to 10%. Now they have gone to around 5%. And the lending rates were close to 20%. Like, I'm not saying exactly 20%, but there can be different variable rates. They were on the high side. Now they have gone to low side. Deposit rate also have gone to low side. That means when the central bank cut policy rates, market rate also go down. Then the other one is expectations. These days, you may, if you want to conduct a survey, this one you have to ask from people who are investors actually, and also we can say rational people. These days, if people have been earning interest by depositing money with commercial banks or investing in interest-bearing assets. Now, interest-bearing assets are treasury bills, treasury bonds, and also debentures. There can be other instruments. I'm not going to talk about the share market, because share market, even though the share represents a financial asset, it has so many factors. Therefore, we are not going to take it here. But if people are either putting their money in commercial banks or in interest-bearing assets, if the interest rate structure, usually we say interest rate structure, if the overall interest rate structure goes down, people who have been living on interest income will think of an alternative ways of using their money. Then they might expect, okay, land prices are better. And recently, gold prices have gone up. 1 pound is 100,000 rupees, I heard. So when people expect gold prices to go up because of the falling interest rates, and also there are so many factors affecting the gold prices anyway, what matters is this. People can start expecting so many things and working accordingly, doing accordingly. So the expectations are also affected. When the interest rates are lowered, they expect a lower interest rate structure. When the official rates are raised, they expect higher interest rate structure. Market rates also accordingly there. Okay. Then see, then these are the channels. Then due to, again, we can say there's a link between these two. When people get the information about the market movement of market interest rates, that also can influence expectations. And the other thing is this: if the expectations are for interest rates to go down, that also will have an impact on market interest rates. It is very nice. You can see policy interest rates affect these two variables separately, expectations and the market interest rates. Then they are interconnected. Any changes here will affect changes here, and changes here will affect changes there. Then you can see it is a really interesting also, but a little bit complicated mechanism. Okay, due to those things, what happens? See very carefully. Money credit. Okay, credit expansion can change. Let's take the recent times. Now, in recent times, the interest rates have, I can say, let's go to that and come back to this one. See, anyway, we will revisit this. This graph indicates, these are actual numbers I have got from central bank press releases. Central bank issues monetary policy press releases. These numbers are actual numbers. Here, 16.2 means 2016 second monetary policy announcement, press release, second press release. This is 2016 seventh press release, 2018 second press release. It's like that. Just to save space, I put this. This is the year. This is the number of the policy statement. Year, number of the press release. Year, number of press release. Okay. See what has happened. Now, okay, at a glance, we can see what has been happening over time, starting from 16, that is over the last 4 years, what has happened. There's a period, interest rates have gone little up. Again, there's a period where they have remained constant. Then significant drop for a longer period. So if you are familiar with statistics, for this graph, if we draw a trend line is for them to go down. This is the standing lending facility rate, standing deposit facility rate. This is SRR. So central bank has cut the SRR also. All three variables indicate the monetary policy has been to ease the monetary policy or expansionary monetary policy. Okay, let's leave it there. And come here. When the interest rates go down, when the market interest rates go down due to those changes that we saw, what happens? Interest rates are the cost of funds, because interest rates are cost of fund. Then people may tend to borrow more if the interest rate is low. Therefore, credit will increase. Official interest rates will go down. Market interest rates also will go down. That will encourage people to borrow more. Credit from the banking system will expand. This is assuming all other factors to remain constant. All other factors to remain constant, right? Okay. Then what is this? Asset prices. What happens to asset prices? When people have more money, because expansionary monetary policy can enable them to have more money, then what happens? Asset prices will go up. Asset prices will go up. And also, you may know, asset prices and their rate of return are negatively related. Asset prices will go up, credit will go up. What happens to bank rates? Banks also will adjust their interest rates accordingly. This is the money market rate. Don't forget, this rate and this rate are different, because this is basically referred to. This refers to SLIBOR, Sri Lanka Interbank Offer Rate. That is short-term overnight call money market, because that is the most liquid market. That is the shortest market. Money market rates will go down. Bank rates also will adjust accordingly. And then exchange rate. Then basically we can identify, there are starting points is the official interest rate that affects expectations and also the money market interest rates. They in turn affect credit, asset prices, bank rates, and also exchange rate. This is called credit channel. Asset price channel, bank rate channel, exchange rate channel. Okay, now actually when you say bank rate channel, this is interest rate channel. Usually this is called interest rate channel. Asset prices channel, credit channel, and exchange rate channel. There are 4 channels we can identify. Then what happens? This is, you can see, up to this point, we see operations are within the financial sector. Central bank, of course, these expectations are coming from people side, and money market is in the financial system. All these are in the financial system. What about this? Wages and price settings. Wages are in the labor market. So now we are shifting from here to the real sector. Supply and demand in goods and labor markets. These are the real sector. We can draw a line here. This is a copied picture, so I have not drawn this. I have simply copied this. You can draw a line here. I don't know whether it's possible. Let's see. Let's see whether we can draw a line here. Oh no, we can't. No, it's not possible. I'm sorry. Okay, now we can't draw it, but in your graph, if you have got a printout, then draw a line here. This is the line which separates the financial sector and the real sector. Remember, we said monetary transmission mechanism is a process. You can see it goes through different stages. So it is a process where the impact of official decisions, impact of the monetary policy decisions, here the decision is to change the interest rates, affect finally this one. This is the real sector. You can see the impact has to go through so many different channels. There are many variables. This is money credit is a variable. It's a banking credit variable. Asset price is a variable. Bank rate, interest rate is a variable. Exchange rate variable. We don't know which one will be affected because we can't expect all these four variables to respond at the same rate at the same time. They can vary, and also it takes time, and there is a lengthiness, and also okay, time, this unpredictability. Then here in the real sector we can see wages and price settings. This is related to the labor market. You can see here it is a labor market. In the labor market, when the interest rates go down, market interest rates go down, that will create more opportunities for people to borrow. If they are going to invest them, then there will be demand for projects. There will be demand for employment as well. Then wages can go up. When the credit is there, people will get more money. And when they start spending, prices also will start rising. You can see what is the reason possibly for the central bank to cut interest rates. If we go to our earlier slides, see, if the economy is in a stagnant situation, the nature of the monetary policy should be expansionary. What is the objective? Objective is to push the output level from the existing level to the sustainable level. Prices also to push the prices or the inflation rate to the sustainable level. That is the objective. Then if we start with a situation like this, under expansionary monetary policy, central bank should cut interest rates. Okay, when central bank cut interest rates, let's check whether this happens, whether the output start rising, whether the inflation starts picking up. Let's check with our graph. Okay, situation in the economy is stagnant. Nature of the monetary policy is expansionary. Immediate impact is the market interest rates to go down. Expectation also for low interest rates. And leaving these sides out, there will be more creation of money, more creation of credit by the banking system. Then people will have more money, and investors can have more money because at a lower cost they can get. They will start investing in real sector projects. And when the real sector projects are activated, it will create more employment opportunities. Then if there is more demand for labor, naturally, it starts pushing the wages up. And also, when the employed people are going to get more money in their hands, they also will start spending. prices also will go up. This is another one. Then again, we will select only this channel and let's come to later this one. Here, supply and demand in goods market and labor market. Okay. What will happen here? What will happen to supply? Now, when new projects are started, when people get more money at a lower cost, they will start producing more. As a result, supply also will increase. Actually, first, the demand will increase. When the demand for goods and services increase, it will have a pressure in the market for the prices to go up. When the prices go up, without increase in the cost of production, firms will start experiencing rising profitability. Then they will start producing more. Supply also will increase short-term supply. If certain factories were running only one shift, if the demand is rising, the prices are rising, and the profitability is also increasing, they will start producing with two shifts. So the supply will increase. The supply and demand for goods and also labor market, that is this demand for labor also will increase. This is the final output. Domestic prices will start rising. Why? Because the demand is increasing. When the wages are rising, we have to understand one thing clearly. Those things will not happen over time. If a baker, for example, let's say, if a baker has to produce more, if a baker sees more demand is coming for his products, he has to produce more. When he has to produce more, because the demand is rising, when the demand is rising, prices are rising, the profit margin is increasing, they will hire more laborers. When the demand for labor goes up, wages also tend to go up. Then it adds to the cost of production. Then naturally, the baker will adjust its selling prices little higher. So that is coming from the cost side. Earlier, it came from the demand side. Final outcome is domestic prices will start rising. Okay, then this price development is that domestic prices will start rising. So economy was stagnant, and the central bank wanted to stimulate the economy. Yes, output increased because now you can see demand and supply are both increasing. Then prices also go up. Okay, now before going to this, let's look at this part. Let's look at this part. Interest rates go down. What will happen to the exchange rate? Here, we have to understand the link between the domestic interest rate and foreign interest rate. If an economy is experiencing free capital flows, what happens? Domestic interest rates and foreign interest rates are linked. If there are no barriers for capital flows, this is an extreme assumption. In case of Sri Lanka, people cannot take money away from the country, invest in India without any restrictions. There are restrictions. And also people can't bring in money also. There are rules and regulations related to that. But if we assume a situation where if you wish, suppose that you are investing your money both in domestic, that is rupee denominated assets and dollar denominated assets. So assets are the same, but the denominated currencies are different. If the US interest rates are rising, whereas the Sri Lanka interest rates are falling, if there are no restrictions, you can shift this money from rupee denominated assets to dollar denominated assets. Why? Because of the interest rate differential. It will move. Then what happens? When people shift rupees to dollars, then foreign exchange markets start operating. So in the foreign exchange market, there'll be more demand for dollars and more supply of rupees. As a result, what happens? Dollar exchange rate goes up. Dollar appreciates, rupee depreciates. You can see it happening here. then when dollar appreciates, it can have an impact on imports. Import prices tend to go up. It is the other way now. Here, the domestic prices go down. The import prices, prices of imported items will go down. So go up. So this is to some extent, this is neutralizing. This is neutralizing the impact there. That is one main argument these days people have against the central bank policy, because now central bank is cutting interest rates, expecting to revive the economy, because the economy is at a stagnant situation, just to help ailing companies, ailing firms to revive their economic activities. So to encourage them to invest, they are cutting interest rates. But what is happening as of now, that is in the domestic front. In the foreign front, what is happening is, when the domestic interest rates are falling significantly, without commensurate drop in the international interest rates, there's a likelihood of money flowing out of the country. That is dollars, foreign currency flowing out of the country. That will have an impact on the rupee to depreciate. There's a pressure for the rupee to depreciate. Actually, when you try to achieve one thing, you are losing the other thing. So it's a matter of balancing two sides. So the exchange rate channel is, according now, the impact on prices coming through the exchange rate channel on import prices, and therefore the price development is reversal of what we are seeing from this side. But anyway, it is a channel. There's a channel, because imports are also in the real sector. When the imports become, then one important thing happens here. When the import prices rise, what happens? When the import prices rise, people tend to think to shift from imported items to domestic items. Now, for example, if potato prices imported, if the dollar appreciates or rupee depreciates, if you have to import potatoes from India at a higher price than earlier, potatoes are produced here in Sri Lanka as well, then people find it is relatively cheaper to buy domestically produced potatoes than buying imported potatoes. So naturally, demand for domestic potatoes will increase. Supply also will increase accordingly. What happens to the domestic prices of potatoes? Compared to earlier, since people are shifting from imported potatoes to domestically produced potatoes, there will be pressure in the domestic potato market. That also will increase the prices. So these are the imported ones. Here's an alternative. Finally, prices will increase. But here the impact, direct impact here is negative. But this adjustment is coming through shifting from imported ones to domestically produced ones. Finally, objective is achieved because the demand for domestic products will increase. Supply also will increase accordingly. But anyway, domestic prices of domestically produced goods, prices of domestically produced potatoes also will increase. This asset prices channel is also called wealth channel. When the asset prices rise, assume that you are an asset holder. Suppose that you have a portfolio of assets. You have portfolio assets. As the land is also an asset. Now these days, if people are shifting their funds from the financial assets because the interest rates are falling, if people are shifting their funds to the asset market, demand for assets will increase. The simple demand supply conditions will apply there. When the supply remains the same, but the demand prices, asset prices will increase. Okay, if you had a portfolio, when the asset prices rise, you feel wealthy. It happens in the share market. When the share prices go up, even without selling your shares, you tend to measure your asset based on the going prices. If the share prices are rising, you tend to feel, okay, I am wealthier now compared to earlier. Therefore, what happens? Wealth is another function of, let's go back to our, all these are linked. I'm sorry if I am making you a little bit confused, but it is not confusing. Now see, when it comes to consumption, earlier we said interest rate is one determinant of consumption. Wealth is also one determinant. When the asset prices rise, asset holders tend to feel wealthier compared to earlier. Then consumption will increase. As a result, aggregate demand will increase. As a result, prices will increase. That is the wealth channel. That is the wealth channel. Okay. When the wealth increases, there will be demand for, because people will adjust their consumption patterns accordingly. They tend to spend more. As a result, demand will increase. Short-term supply also will increase, and domestic prices will start rising. Bank rate, when the money market rates fall, bank rates will have to fall. We know that in the banking sector, as we said earlier, the rates that were close to 10 have gone down to around close to 5 now. So then demand will increase, supply will increase, and also here here one important thing is there. When the bank rates go down, savers will save less, borrowers will borrow more, because interest rate affect borrowers and savers in two different ways. If the interest rate is high, it is a reward for savings. But if the interest rates are falling, reward is less. Then rather than saving, people tend to consume. So then the savers' demand will increase. And if people are borrowing and consuming, they also will start demanding more because their cost of funds are falling. So from both borrowers and savers, demand will increase, short-term supply will increase, and prices will increase accordingly. So if there was deflation, the prices will start rising. Okay, now let's take the other side. If the interest rates are raised, here we started with expansionary monetary policy. But if we start with contractionary monetary policy, interest rates will rise, rates will rise, there will be less credit and less demand for this one, and the less demand for goods and less supply, and prices will fall, because when the demand falls, prices will fall. So it is somewhat similar to this. Again, we can look at this. Contractionary monetary policy is implemented when the economy is overheating, and contractionary monetary policy is characterized by either cutting money supply or raising interest rates. When the interest rates are raised, aggregate demand shift to the left. Accordingly, output also will tend to fall. The inflation also tend to go down. So that is the channel. Now you can revisit this graph several times whenever you want. You can see how the contractionary monetary policy and expansionary monetary policy finally, this is the final outcome. The final outcome is for the output to change and also the prices to change, the final outcome. And what we are discussing now is how it happens. All these channels are there. Then what is this? Shocks outside the control of the central bank. Okay, we say these things will happen. We say these things will happen. But the problem is, we are not sure whether exactly these things will happen. Why? There are so many variables outside the control of the central bank. If the central bank can have the complete control over this, these things will happen. You may remember the ceteris paribus assumption. When all other factors remaining constant, remember the law of demand, when all other factors affecting the demand is stable, price and quantity demanded are negatively related. But other factors may not remain constant. Therefore, there is no guarantee that the price and quantity are negatively related. It may not happen all the time. The same way, when central bank does this expecting any of these channels to work and the transmission to flow through any of these channels, all channels, so any of these channels at different degrees, finally influencing the price level and output level, there can be so many constraints like this which will not support the central bank to achieve its objectives. What are those? Changes in risk premium. When the interest rates are lowered, some due to changes in the risk premium, it may not happen. Because we know the market interest rate is a combination of cost of funds and also the risk premium. There can be so many different risk dimensions are there, so it may not happen. Then changes in bank capital, and banks, even though the banks, this encourage banks to this thing, assuming that nothing happens like this. When the interest rates are lowered, if the bank capital is not sufficient, banks may be a little bit more cautious. Bank may be cautious because it may not expose the bank to high risk if the absorption capacity of the bank is less because due to changes in capital. Changes in the global economy. Now these days, take the garment factories. Now the garment factories can get the loans at a lower cost from banks, but because of the gloomy economic environment in the globe, because most of the markets for the Sri Lankan apparel is now affected. Therefore, even though from the policy front, from the official and market policy front, even though it is encouraging for these garment factories to borrow more and produce more, since the gloomy economy, because of the gloomy global economic conditions, there may not be demand. Even though they can supply at a lower cost, if demand is not there, finally this may not happen. Changes in fiscal policy. Here, these days, if we look at the Sri Lankan environment, both the fiscal policy and monetary policy are expansionary. Government is cutting cutting tax rates and giving subsidies and encouraging people to, and also firms to spend more and invest more. Monetary policy is also supporting that by cutting interest rate. But sometimes there can be a situation like this where central bank wants to curtail credit. Central bank wants to conduct a contractionary monetary policy. Central bank does not want the credit to expand and demand to expand and also prices to rise. But then central bank may conduct a contractionary monetary policy. When central bank does that, the nature of the fiscal policy may be expansionary, especially when it comes to in Sri Lanka, we have experienced that in many occasions, but recently both the government and the central bank had to be expansionary because of the special situation. The economy was affected by last year by East attacks and this year by COVID-19. Therefore, both had to be in the same line. But there are certain areas, certain periods where inflation is looming. When the inflation is rising, central bank tries to control inflation by conducting contractionary monetary policy. But if that is an election year, the government may want to spend more and hire more people and give more employment opportunities and give subsidies. So the fiscal policy is expansionary. Monetary policy is contractionary. Fiscal policy is expansionary. So then if that's the case, central bank may not be able to achieve its objectives by adjusting the interest rates. So that is fiscal policy. And change in the commodity prices. And when the central bank wants to have a lower inflation, prices may rise due to change in supply side, because commodity prices can change due to both demand and supply side. Okay, let's go back to our graph here. Here we can see, if we draw a graph here, if there is a drought condition or flood situation, sorry, yes. Okay, suppose that there was a shift in the supply. Now, this is the original situation. Now, there's a shift in the supply. What happens? Central bank wants to cut prices by cutting the aggregate demand, but because of the drought, that is coming from the supply side, there will be supply shortage. Prices can push up. Even though the central bank wants to cut prices by contractionary monetary policy, shrinking the economy can push the prices up. So that can be a constraint for the central bank to achieve its objectives. Okay, now let's stop here and ask our participants to raise any questions if they have. Did you understand up to now? Okay, there are so many queries. Okay, let me read. Sir, what would be the reaction to bank rate and exchange rate in relation to money market rate? Sir, what would be the reaction to bank? Reaction means reaction to bank rate and the exchange rate in relation to money market rates. Now, Gerald, here, the question is a little bit not clear, but if you are referring to the relationship between the money market rate and the bank rate, Gerald, is it this bank rate means what? Is it the rate that the central bank imposed on commercial banks as the penalty rate? Hello? Yes, okay. This is different thing. Actually, bank rate, now if you are referring to this bank rate is a special rate, because if a particular bank is finding it difficult to manage its short-term liquidity, and if there is no any other way a bank can borrow to meet the liquidity requirement, it has to go to the central bank and declare, okay, that they have lost their financial control. In that case, they can borrow from the central bank, but not the rate that is not the standing lending facility rate. Because one requirement for commercial banks to borrow from the central bank at the standing lending facility rate, they have to have short-term assets, either treasury bills or bonds, against which they can borrow from central bank as a collateral. But if they don't have it, there is only way that they can do is they have to borrow from the central bank. That is the banking rate. Now it is 10% now. Early it was 15%. Now it is 10%. That is called penal rate also. So it is a special rate, Gerald. But if you take the market interest rate and exchange rates, again, we can't say exactly what relationship they have, because there are so many factors that affect the exchange rate movements. If we assume all other factors to remain constant, then lower interest rates will make the domestic currency to depreciate. Higher domestic interest rates compared to foreign interest rates will make domestic currency to appreciate. Because all these are linked, Gerald. We can't say exactly, but okay, then there's another one. Okay, from you again, sir. Since foreign interest rates also dropping in foreign countries, does the cutting down domestic interest rates have negative impact in the economy, or does it neutralize? Yes, this is a really good question. Sudha, now this again, it depends. It depends on to what extent those lower interest rates affect Sri Lankan market. Because when the interest rates are going down there, there is no possibility of comparing one-to-one relationship, because by the time the interest rates are changing, risk dimensions are also changing. Risk dimensions are also changing, because if you take Sri Lankan situation now, as at now, this is nothing to do with politics. Now, still, people are not 100% sure about what type of an economic policy this government will implement, and also there are so many problems for the government, because the government budget is very, very weak, and there are so many. And the government budget is weak, and also government has to pay a huge amount of debt, around $5 billion by this year, I think. That means it has a precarious financial situation. It has, because we can't blame this government. It is this, whatever the problems we are having as at now is an accumulated problem from the past. But as at now, the country's risk situation has increased with respect to budgetary management, and also with respect to debt servicing. Therefore, even though the interest rates in those countries have gone down, we can't say their drop in foreign interest rates will neutralize the negative impact of domestic interest rates. Is it clear, Gerald? Gerald? Is it clear? Okay, right. Any other questions up to now? Okay, let's go to our slides then, if you have no questions. Study this graph very carefully. And also, if you have questions, because we will have more lectures to come. Therefore, anytime you can ask questions related to this or any other slides that we have discussed up to now. Let's go to limitations. Limitations of these are also, now if you look at all these are list of limitations. All these are list of limitations, but here I have put them. These are different channels. Interest rate channel, exchange rate channel, asset price channel, credit channel, expectation channel. These are the basic channels. As I said, this bank rate is the interest rate channel. This is expectation channel, means expectations are coming directly from there to this. This is the expectation channel. You have a link like this: credit channel, asset price channel, or the wealth channel, as I said. This is the interest rate channel. This is the exchange rate channel. All these channels are here. I think you are required to understand these channels. And also, if you are a researcher, even though we said all these channels work, there is no guarantee that all these channels will work the same way that work in other countries in Sri Lanka. Sometimes, now if you take Singapore even does not try to maintain price stability, because central bank, this Singapore Monetary Authority is not concerned about inflation. They are concerned about the exchange rate, because they are anchor. They call it this nominal anchor. In Sri Lanka, nominal anchor is the consumer price index, consumer price inflation. They are trying to maintain a stable inflation rate. And any changes in the exchange rate is secondary, because it is a byproduct of this. But in Singapore, they focus on the exchange rate. The same way that the Central Bank of Sri Lanka is monitoring the consumer price inflation to conduct its monetary policy, Singapore monitors the daily exchange rate, because by looking at the movement in the exchange rate, they can take decisions accordingly. That is called exchange rate targeting. Now, here in Sri Lanka, we have monetary targeting, or inflation. Sorry, we had the monetary targeting. Now we have inflation targeting. Singapore has exchange rate targeting. Okay, it depends on which variable they target, which variable they are trying to maintain stable. And in some countries, still it is not prominent that much. In some countries, they try to maintain domestic gross national income. They call it nominal income targeting, nominal income anchor. It is not prominent, but sometimes there are concepts. That is, there can be monetary targeting, there can be inflation targeting, there can be exchange rate targeting, there can be nominal income targeting. Different countries do it, but mostly used target is inflation target, because Singapore is a very small country, and also it is a very highly concentrated, active, dynamic trade center, global trade center. What matters for them is the exchange rate. Therefore, they target that. Okay, this let's go to this. Now, I wanted to show you in a period of 4 years now, starting from 16 to 20, 2016, 2020, the monetary policy has followed all three different scenarios. Now, this is contractionary monetary policy. Again, this one is little bit expansionary. Again, contractionary, and no change, neutral monetary policy. There's no change, but after that, continuously expansionary monetary policy. Here also, SRR is stable, and continuously it has gone down, again remains stable, gone down, remains stable, and gone down, remains stable. So this is very important. And somebody can ask the question, because I think there was one particular period where they had not changed the interest rate. This one. Look at this. In 2018, 7th Monetary Policy Review, they had 8% SDFR, 9% SLFR. And in 2019, there is no change in those rates, but SRR is cut, right? So if you take all the, if you take only this part, monetary policy is neutral. But at the same time, central bank has been a little bit expansionary. Interest rates have, whether the SRR has gone down. When the SRR goes down, money multiplier increase, because credit multiplier increases. Banks can create more credit. As a result, money multiplier increases. Therefore, money supply increases. This is the period. During this period, central bank was targeting. The central bank was following monetary targeting framework. Now, central bank is following inflation targeting framework. This is important. Then somebody can ask the question: why? What is the reason for the central bank to keep the policy interest rate unchanged? But policy interest rate unchanged, but cut the SRR. Now here, this is little bit advanced monetary economics, because the dimensions, the impact of lower interest rates and impact of lower SRR may not have the same impact. They may not have the same impact. Interest rates directly affect. This may not be a good example, but they say if you add sweet on alcohol base, your sugar level will increase fast. Why? Because alcohol is absorbed to the bloodstream very fast. Therefore, if alcohol is containing sugar, sugar level will increase faster. But you can have the same level of sugar, but not through alcohol, but through other means. Then sugar level will increase, but not at the same rate not at the same fast rate as it was with alcohol. Therefore, if you adjust the interest rates, the impact will be faster. But if you adjust the SRR, it will take some time, because the bank will start creating more credit, and creation of more credit will increase the money supply, and the interest rates will start falling. So that takes a little longer time. But here you just cut. See here. So 7 to 8%, 8% to 7%, and here 9 to 8%, 100 basis point. Then certainly it will have an impact on market interest rate. Therefore, even though the nature of the policy during this period is expansionary, we can't say impact coming from this one and impact coming from this one are the same. They are different. There was a debate. I was lucky enough to engage in some activities related to this. There was a debate about why did the central bank choose SRR, cut SRR while keeping the policy interest rate unchanged. At that time, people argue if the real sector is more sensitive to the policy interest rate, but if the central bank does not want to introduce a shock there, but central bank wants to have a little bit of an expansion in monetary policy, the better policy option is to use the slow path. This is the fast track. This is the slow path. And in certain periods, you may have seen, while central bank maintains the same SRR, see, here SRR is the same, but central bank wanted to have a fast track. See, the policy interest rates were cut. And here, they have cut both gradually. Because now here, if you look at this period, this is the COVID-19 period. And because policymakers were desperate about the slowing down, therefore, they went on a fast track and addressing both. Here the rates were cut, all three rates were cut, and they were cut further. Again, this one was cut by half, and then again they were cut further. Analyze this very carefully, read this, and it is interesting. You will understand the actions of the central bank. Okay, now I want to go to this. Factors that influence the monetary policy decisions. Let's look at the time now. Okay. Before going to this, I think you must have received 4 central bank monetary policy press releases. Have you got? Can I see your answer? Have you got monetary policy press releases? Okay. Gavi Bandara, yes, you got, no? Right. Okay, now those four monetary policy reports, I don't remember exactly which one. I think 2016 one was about central bank raising the interest rates. And 2018 and 19, they were unchanged. They were maintained the same rate. There is a neutral monetary policy. Early it was contraction monetary policy, neutral monetary policy, then expansionary monetary policy. If you go to the central bank website and monetary policy press releases, you can find all these. I have simply copied from the central bank website. You can find them, but I have chosen 4 which are related to. One was related to raising the policy interest rates, that is contraction to monetary policy. The other one was maintaining the same. There were 2 which were for expansion in monetary policy. And there is, I don't remember exactly what, I think maybe the last one, also the one issued in March. Central bank specifically mentions as a measure to address the issues related to the COVID-19, central bank is taking these decisions. That is from time to time. From time to time, there are two things. Central bank can have a long-term view. Long-term view is the long-term price stability and growth. But if a contingent situation like what we had with COVID-19 comes, central bank has to implement policies drastically. This graph highlights that, because in a shorter period, there was a significant drop. See, 7.5 became 2%, 8 became 5.5, 6.5 became 4.5. So there in a shorter period, significant drop. It is not common for us to see central bank cutting interest rates or SRR at a significant rate like this. Usually they cut by small quantities. There's a good analogy. Usually monetary maneuvering, or we can say conducting the monetary policy or guiding the economy through the monetary policy is like captaining a ship, maneuvering a ship. Because ship, you can't turn at the same pattern that you turn this race boat. Boat, you can just turn like this. It's small and you can maneuver. But if you are going to turn the ship like that, ship will definitely turn the other side upside down. So therefore, little by little, the ship has to be turned little by little, small changes. But here, when we look at this graph, towards the middle part of the 2020, central bank has been little bit aggressive. We can say little bit aggressive in conducting the monetary policy. Why? There was a significant or drastic drop in rates in a shorter period. It's like turning a ship within a shorter distance. But usually, ship has to be turned with a longer curve, and it has to move slowly also. Then only you can go to the expected destination. Be careful about that. And also, then some people argue, not only for Sri Lanka, many countries in response to this COVID-19 pandemic situation started drastic expansionary monetary policies. But now they are arguing, could this backfire once the economy recovers? Because now there's huge amount of money out there in the economy. Trillions of dollars have been pumped. And the same thing happened during the global financial crisis. Many countries conducted non-conventional monetary policy and pumped money to the system. And later on, they observe inflation emerging. Before they observe the full extent of that when this COVID-19 came, therefore we can't exactly say what was going to happen had this COVID-19 were not there. Therefore, it is difficult to explain at this time. The problem is, if you have a drastic policy changes, you should expect significant changes in the economy and possibility of them backfiring, affecting your macroeconomic management may be there. Therefore, you have to be careful. Because money is there. If the output is not going to expand, money will follow, or money will chase smaller quantity of goods and services. Inflation will come. When the inflation comes, it's like economy having the human body having diabetes. Because diabetes is a silent killer. It has so many negative impacts on the body. The same way, if we have inflation coming in, and if it is not managed properly, the economy can have so many ailments. So that we have to be careful. Now, when you go through all those 4 press releases, I have put what they have looked at. I again earnestly request you to go through those monetary policy reviews very carefully and read what they have highlighted. The economy grew at this rate, and the credit expansion was this much, and also the exchange rate was like this, and the external economic conditions were like this, and the inflation expectations were like this, and as indicated by the purchasing managers index or the business confidence index, these were the conditions. By considering all those things, the monetary board of the central bank felt it is reasonable, okay, to maintain the same rates, or it is time for the central bank to introduce tight monetary policy. Therefore, central bank decided to raise these rates. And the other time, because of these reasons, finally, board decided to cut interest rate like this. So final statement, carefully read what the central bank is, what the monetary policy has decided, and what were the factors for the central bank to do that. What factors has the central bank considered in doing this? And that two sentences are supported by the lengthy explanation at the very beginning. You can read them. Let's look at what the important points are, irrespective of whether the monetary policy is expansionary, neutral, or contractionary. These are the factors they look at. Of course, they can go up and down. Board arrived at this. I have put this sentence just for you to be familiar with those press releases. The board arrived at this decision following a careful analysis. See, following a careful analysis of current and expected developments. My dear, you have to be very careful. They don't look at only the current situation, and also they look at expected developments. This is where the projections come. This is where the central banks being a forward guide. We say central bank monetary policy is forward guidance. So this is because they look at the expected developments as well. Let me repeat again. The board arrived at this decision following a careful analysis of current, I emphasize current, and expected developments in the domestic economy, and financial market, as well as global economy. See how many things they have a look at. Domestic economy they have a look at. Separately, they have a look at financial market, development in financial markets. You know, when you say financial market, money market and capital markets are there. And what development they have observed in the behavior of money market and capital markets. And also, globally, what has been happening. That means foreign interest rates, foreign exchange rates, and all those things also they look at. So this summarizes the entire thing. Let's look at what they look at. Prevailing macroeconomic situation and future prospects for economic growth. Now, if you take the current situation, the economy is stagnant and the growth is very slow, lower than the potential, then the requirement is to stimulate the economy. And future is also gloomy because the global economic conditions have been affected. There is no likelihood of tourism or foreign investment coming into the country in a shorter period. And also the prospects coming from the Middle East, these remittances are also gloomy. Therefore, there are so many negative things to come in the future. Current situation is also bad. Therefore, central bank has to be expansionary. Monetary policy has to be expansionary. Central bank did that. External sector performance with respect to foreign exchange flows and movements of the exchange rate. The same thing that, as I said. Market liquidity and the behavior of market interest rates. They look at what is the liquidity situation, what is the behavior of market interest rate. They look at indicators of business confidence. This is about the investors' feelings about the near future. Central bank conducts, statistics department of the central bank conducts a business confidence survey. When we discuss on the departments, you may remember. Central bank, there's a statistics department collects information, data related to the real sector, and also they conduct a business confidence survey and also purchasing managers survey, just to get an idea about what the people think, what the business community thinks about the coming future. So accordingly, they can decide whether the economy is going to slow down or heat up and take decisions accordingly. operations of banks with respect to credit expansion. Recently, you may remember the little bit of an uneasy environment created between the central bank officials and the president, and also the banking community. So there was a little bit of a blame against the banks as not supporting the government by expanding credit. Therefore, they look at that. But we know the credit expansion is not that easy. As bankers, the bankers will have to look at so many different factors in extending credit. Central bank also can't right away give money. There are so many factors affecting that. But anyway, central bank has to look at. And I remember when the banks were not cutting their deposit, borrowing, lending rates, and also banks were not lending to the expected rate, central bank had to take special actions to encourage banks to lend. That is against a part of the expansionary monetary policy. Present and medium-term inflation outlook. You can see each and every press release that you are holding in your hand that I sent you, they talk about two different inflations. Headline inflation and core inflation. Headline inflation is price taking all the prices into account. Core inflation is the prices of items which can be influenced by the central bank monetary policy, because supply side factors, central bank cannot influence the prices of coconut, because coconut prices may depend on the supply may depend on the weather conditions, and central bank cannot influence the vegetable prices, because again, weather conditions and other factors can affect vegetable prices. Those are not sensitive to the interest rates. The core inflation is with the basket of goods and services which are sensitive to the interest rate. The central bank look at that. Central bank look at both. Central bank look at both the headline inflation rate as well as core inflation rate. They look at the past, what has been happening to inflation, what is happening as at now, what is likely to happen in the future. They look at all those things. Read those press releases carefully and try to identify these factors there. What they have said when they decided to raise the rates, what were the developments with respect to these variables? Then they decided to maintain the same rate without any change, what were the development in these variables? And when they started cutting rates, what were the development in these areas? Therefore, you have to look at very carefully. Then it will be very interesting. Here, I have to discuss, let me check. Okay, we have little time, but I don't think within 15 minutes I can't cover that area, because next time I want to discuss about the central bank communication policy. When the central bank when the monetary board decide a particular monetary policy decision that is communicated to the public, they call it market. That is communicated to the market by way of a press release that you're holding. It gives details. And also central bank holds press conferences where all the media people are invited. They can raise questions, and a set of technocrats are sitting there, including the governor, deputy governors, and the monetary policy committee people are there. Then the press people can ask questions. Why did you take this? And last time you did this time you did this. And during this period, somewhat similar things are happening in that country, maybe US, Singapore, UK, Japan, whatever. But they are doing this, why you are doing this? Then they have to clarify. Okay, because of these reasons, we took this decision. Like that. The communication is very, very important. Why? Because central bank can take, because this monetary board conduct meetings on the 15th floor in a control room. Now they have this restricted room. The monetary board meets there, take decisions there. But if they take decisions and if that is not communicated to the public, nobody can know what the central bank is expecting. Therefore, central bank has to announce it to the market. okay, this is what we foresee. Because all these details in the press releases are telling you what the central bank has observed, analyzed. See the sentence, board arrived at this decision following a careful analysis of current and expected development. So when the general public or the business community read this, they understand central bank seems to have conducted a thorough analysis of what has been happening, what is happening, what is likely to happen. Therefore, they have taken this decision. So therefore, we also will have to align our thinking, our expectations, our plans, our projects accordingly. Then their expectations also will be in line with central bank expectations. Everybody will be moving on the same direction. Therefore, then together, because price stability, growth, prosperity are things that people can achieve together, not individual. Therefore, everybody has to work towards the same goal. Then everybody will be working toward the same goal if everybody knows what is happening, what is going to happen, what everybody has to do, what the leader is, what signal the leader is giving. In this case, the leader, monetary policy leader is the central bank. What guidance, what signal the monetary policy central bank is giving, they have to follow on those lines. And also don't forget, not only giving signals, but also central bank can control the financial markets through the most very powerful variable or instruments, the interest rate. Interest rate affect everyone. So when the central bank holds that authority, and also when with confidence central bank announces it, others follow. But for that to happen, the communication should be very powerful, very clear. Clarity should be there, consistency should be there, and broad-based communication should be there. Therefore, communication department of the central bank is very, very important. It helps people to understand. It also helps people to form their expectations accordingly. For the time being, that's all for today, I guess. Any questions? Any questions? Gayumi, Nallaya, Gerald, Palinda, Amanda, and Sachin. Who else? Okay, let's be a little bit friendly and talk. Don't worry about your language or whatever you ask. Any questions? Why are you so silent? Unmute your mics and talk. Reluctant? Okay. Then at least tell me whether you understood what we discussed today. Understood. Okay. Now, next time, what we will do is, before we start another topic, I want to focus your attention to important areas in this syllabus, because finally, at the end of the day, you want to pass this paper, no? So I don't know what questions will come, but I want to guide you. I want to guide you what to look at. Okay, irrespective of what questions will come, let's try to understand the key crucial areas, key areas. Okay, if you take the central bank functions, these are important. If you take monetary policy, these are important. If you take central bank departments, these are important. If you take central bank balance sheet, these are important. So once we have understood, since we have discussed all those things in detail, once we have understood the key points under each subject, it will be easy for you to understand the questions and also answer the questions. And before ending this session, I will spend at least 2 sessions to discuss at least one past paper with you, just to give you a sense of how to read a question paper. Because sometimes we understand, we have observed students sometimes are not reading the question paper question carefully and understanding the area of the syllabus carefully, which part of the syllabus is relevant for this question. And also when they present the answers, sometimes the rational order is not there. So there are three things in an exam. You have to read the question paper carefully. When you read the question paper carefully, your mindset should navigate through the entire syllabus. That's why we have to practice entire syllabus. Then identify the areas relevant to this particular question, pick up the points from that section, organize them in a particular order. Yeah, Gerald, IFC has invested around 50 million in commercial bank. Does it affect the current monetary policy by any way? It may, little bit, not the monetary policy actually, because now it is US dollars, no? US dollars. It depends again. It depends on whether this money is going to come to the official reserves or not. If they come to the official reserves, it will be an indicator that, okay, official reserve position of the central bank has gone up. The maneuverability central bank has to participate in the foreign exchange market is high. Therefore, if there is any pressure to come in the market, will be a little bit eased. Gerald, we will discuss those things because I'm going to discuss about the central bank balance sheet, and also central bank operations, and also the impact of different variables on the central bank maneuverability. We will discuss that. This one, Gerald, we cannot say exactly because what you are saying is ICF has invested 50 million in commercial bank. Does it affect the current monetary policy by any way? The answer is not directly, not in the short term. And also, while this 50 million is coming to the pool, there will be so many other ins and outs. And also, we don't know what will happen to this 50 million, whether this is going to be converted into domestic currency or not, we don't know. Therefore, we cannot relate it directly to the monetary policy stance as at now. Is it clear? Okay. Then let's stop here. And I invite you to refer to all the notes that we have done up to now and look at the old slides. Then I'm going to pick up certain areas and discuss questions with you relating it to this pressure points in the syllabus. Pressure point means the points that any examiner will look at. And any examiner will be interested in assessing the knowledge the students will have. Those things we will do. To make it a productive one, you have to do your homework, my dear, because my doing homework is not going to help you, because I am talking and you are the ones who are absorbing and reproducing them in the exam. Therefore, for you to get it clear, be prepared. Okay, thank you very much. We are going to stop a little earlier today. Good night and see you next week. In the meantime, if you have any questions, any comments or whatever, communicate them through the coordinator. I'll be prepared to answer any questions you have. Okay, nice to see you again. Bye. Good night.